Welcome to part one of the absolute basics of buy-to-let, presented to you by Roger Morris. So without further ado, I will hand you straight over.
Thank you, Natalie. Welcome. We're going to go on a two-part journey to cover off the absolute basics to buy-to-let. What this particular two-part series webinar aims to do is to give you the absolute basics to buy-to-let. It's in the title. It's for you to sit back, have a cup of coffee, a cup of tea, and to be able to give you the foundation level to understand when doing your first ever buy-to-let application. Now, most likely, you'll have done CMAP and you may be CAS status or on that journey to be able to do a residential regulated mortgage application. What today is about is to give you that foundation level in a two-part webinar, each one for 30 minutes, to help you understand the beginning of the world of buy-to-let. From this two-part webinar, we will then move into some more structured and more complex learning programs that will help you in small bite-sized chunks understand specialist buy-to-let and the complexities around it. But today, Natalie and I are going to take you on that structured journey on the absolute basics to buy-to-let. Within this presentation, we have to cover off tax. Neither you, nor I, nor Natalie, the Chetwood Bank are qualified to give tax advice, only a tax advisor. However, we must explain during the presentation how the different ownership structures between owning a buy-to-let in personal names and owning a buy-to-let in a limited company can affect the outcome and the net income position after tax for your applicant landlords. And that's very important. So you will be asked at some point by some landlords to explain the difference in the ownership structures and why consider owning in a limited company or why consider owning in personal names. You can do this factually, simply explaining the factual differences, no different than imagine you were out this evening and you were in a bar and you heard a couple arguing about the difference between a fixed rate mortgage and a discounted mortgage on their residential home. Without giving regulated advice, you can then step in and explain the factual differences between the two types of rate mechanisms when it comes to their regulated mortgage. When it comes to buy-to-let, you'll be able to give, at the end of this very basic two-part webinar, the actual absolute basics between owning a buy-to-let in personal names and owning it in a limited company. With the further webinars, and look out for the details of them, we're going to much more complex tax structures, of which we will bring on a tax advisor who is the only person able to give tax advice. So the key aims of this presentation is to understand why landlords invest in buy-to-let, to learn the basics of buy-to-let lending and common terminology and grasp the importance of interest cover ratio, or commonly abbreviated as ICR, and there's lots of acronyms in every industry. Buy-to-let is one of them. To compare personal ownership and limited company ownership structures, you will get asked at some point in the future, tell me the difference and the consequences in a very basic but factual way between owning a buy-to-let in personal names and a limited company. And to approach this market with the right mindset, and the right mindset is something I really want to get across to you right at the beginning. So what is a buy-to-let property? A buy-to-let property is a property which is purchased. So imagine on any street or any road in the UK, a property for sale. And your applicant, the landlord, wants to buy that property and puts in a mortgage application and wants to make this property a buy-to-let. What they cannot do is ever reside in that property or a member of their family to reside in that property without prior approval from the lender. And in most cases, you won't get that. So that property must be purchased for the intention of residing a family in that property, but not your family or your extended family. So if you ever find out that an applicant wants to at some point in the future potentially reside in the property buying that was a buy-to-let, then that in the vast majority of all lenders will be an absolute no. It's called a backdoor residential. And it's very important to make sure and you question the applicant in the beginning. Have they got ever intentions on residing or a family member residing in the property that they are submitting an application for a buy-to-let? Because if they are, and you don't tell a lender or they don't disclose it to you, it's classed as mortgage fraud. And it is and has been a significant issue in our industry. So the example being, if the client is renting and they're renting a 1-bedroom flat and their first buy-to-let is a 2-bedroomed house, then a lender would not believe that the client was not ultimately going to reside there because the buy-to-let is of a higher standard than the property that they rent. So you do really need to make sure that the property is not a backdoor residential. So your mindset to buy-to-let becomes very important. If you are currently CMAP qualified and doing regulated residential mortgages, your mindset will always be ultimately, and to simplify this, to get the cheapest possible monthly interest rate for the client, because that is expenditure that comes out of the family's household bank account, and it's their biggest or potentially biggest outgoing. So if you were able to get them the cheapest rate and the lowest monthly payment, then ultimately, all things being equal, that's the right thing to do. But when it comes to buy-to-let, the monthly payment is not an expenditure out of the landlord's bank account. It's a business deductible expense. Now, let's just say, to make it easy, the mortgage payment is £500 a month. If the buy-to-let is owned in personal names, then technically, and just as a simple explanation, in personal ownership, the landlord will be able to offset 20% of the cost of finance. So let's just say that's £100. However, if they bought it in a limited company, they're able to offset 100% of finance cost. So that will be £500 a month they could offset. What that ultimately would mean is the more they could offset of the expenses that the landlord has to pay, then more likely the more profit they'll ultimately make. So this is something you need to be aware of. And the best example I can give you of how this mindset needs to change from residential to buy-to-let is like driving a car. So I'm going to assume right now that you are qualified to give regulated mortgage advice and that you're qualified to drive a car. So if you were to go out today in the car, you'd most likely do it automatically. You'd approach the driver's side from the right-hand side of the vehicle. You would get in, put your seatbelt on automatically. You do the safety checks and you proceed on the highways, following the highway code and the rules of the law when it comes to driving purely automatically. Very similar to approach of a regulated mortgage. Your ultimate aim is to get the family the cheapest possible deal. But with buy-to-let, it's completely different. So imagine you've flown abroad, landed in Malaga, and you were going to hire a car. You go to the appropriate hire car registration desks, collect your key, you know the bay the vehicle's going to be in, and you walk over to your vehicle. You press the fob, you open the boot, and you put your cases in. You may automatically walk round to the right-hand side of the vehicle to get into the driver's side, and may have done this, laughed at yourself when you realise the steering wheel in Europe is on the left-hand side. You may laugh, get out the car and walk round to the opposite side and get in, but suddenly become very conscious that you are qualified to drive the car, but it's the first time you've ever driven in Europe. And you really do focus on driving because as much as you're aware of the highway code, to a degree, the rules of driving on the left-hand side are different to the rules of driving on the right-hand side. and you become very focused on the outcomes. Well, buy-to-let is the same, because if you've got a top rate taxpayer where you are recommending a 75% purchase in personal names, you do need to explain that they won't be able to offset the largest single expense, most likely, on that buy-to-let's profitability is the cost of finance. So let's say the mortgage payment is £500 a month. Let's say the lender fee is 3%. They would only be able to offset just 20% of that cost. However, in a limited company, they'll be able to offset 100%. And that's a big difference between profit and loss. So if your advice of the ownership of structure is based on the monthly payment, then you need to think again, because that's the wrong mindset, unless you are explaining the net income position after tax, which I wouldn't advise you to do, which is why in all cases, a landlord should have spoken to a tax advisor. So why do landlords invest in buy-to-let? First would be income. So those that don't know me, I've had buy-to-lets for over 30 years. So I can actually elect, if I feel like it, to take monthly income from my buy-to-lets. That's up to me. Sometimes I want to have more holidays, or I want to do other things with my money that I have made from the buy-to-lets, or capital growth. Now, capital growth is not a given. We think all properties in the UK will go up over a period of time, but certain areas that have economic pressures, the areas are not particularly expensive, and therefore property values can reduce equally as much as they can go up. So it's not a given, and it's something that you can't advise or guarantee that a buy-to-let's value over a period of time will go up. However, if we take a statistical average, they will go up, and that's a good thing. So as a landlord myself, I'm always looking for capital growth and income after tax. I've followed a formula, and I've explained to people up and down the country who've built successful portfolios about my formula. There's 4.6 million buy-to-lets in the UK, approximately. 55% of them have no borrowing. So the actual high equity position of landlords today is quite significant. The ownership structure of the 4.6 million buy-to-lets, 55% have no debt, but 45% do. And those buy-to-lets statistically will be in personal ownership. And therefore, a lot of those landlords are having to reconsider, because they are no longer able to offset finance cost as a business expense as they were prior to January 2022. What they will then need to think about is, ideally they'd like them in a limited company where you can offset that as a finance cost change, and which is why now the vast majority of buy-to-lets are purchased in a limited company. Yield will change dramatically depending on who you're renting the property out to. So we'll come into the different types of structures soon, but it's about understanding who you're going to rent the property to and what type of property. So you've got standard buy-to-let, a house of multiple occupation, a house of multiple occupation rented on serviced accommodation, or you've got multi-unit freehold buildings, holiday lets. Mortgage interest rates will depend on two factors. Sometimes personal ownership in low LTVs will maybe attract the cheapest rate, because the entire market that's in buy-to-let will do personal ownership. Not all will do limited companies. But it's about that mixture, how yield, ownership structure can really be the deciding factor. The last part of the advice process should actually be the mortgage interest rate. You really need to work on the first three before you come to that factor, which is what a tax advisor would do. So why landlords invest in buy-to-let? These are my reasons. First, you could be an accidental landlord. And it's very important when dealing with a remortgage, you need to ask the landlord how they originally came to own the property. So was it originally their residential property and they converted it to a buy-to-let? At any point in the ownership of the property, had they ever resided in the property, or their family member resided there, or had they inherited the property? If so, they're an accidental landlord, and this needs to be disclosed up front. And I would always advise, in those circumstances, speaking to the BDM first before even submitting a mortgage application. A lot of lenders will not do what's called a regulated buy-to-let, or an accidental landlord comes into a consumer buy-to-let. But when it comes to a professional landlord, this is where the property was originally purchased with the intent of renting out that property, and at no point ever has they or their extended family ever resided in that property. And it's important that you understand how these key points and checking out at the start of the application about the accidental landlord and whether or not they're a professional landlord for a remortgage. But be clear that they're purchasing a buy-to-let with a mortgage application. At no point can a family member ever reside in that property, because that would constitute mortgage fraud. So what does a landlord want from their mortgage advisor? I am a qualified mortgage advisor, but I no longer practice mortgage advice, but I am a landlord and I use my mortgage broker. I won't mention his name or her name on this webinar, but I do value the services of a mortgage advisor, even though I'd like to think I know a bit about buy-to-let. It's about making sure that you have a comprehensive knowledge of understanding both the lender's criteria, the rules around owning a buy-to-let, with the Renters' Rights Bill now in law, and understanding the value of the other professional services that they will need when it comes to specific and individual advice. But understanding that a mortgage advisor is more like a general practitioner, having to need a basic understanding of all the other components of not just arranging the purchase, but the practical renting out legally, correctly and safely to families and individuals who could be renting that property from them. This is why every landlord needs a support group. So I, as a landlord, will need a mortgage advisor. That mortgage advisor will know all the lenders in the buy-to-let space, will be able to take a detailed fact find of my requirements, whether it be a purchase, a remortgage, or a product transfer. And then by using the sourcing systems for both criteria and rate and eligibility, be able to source the appropriate lender. A solicitor will work out, maybe on a purchase or a remortgage, whether or not the property needs to have licenses, planning, whether or not there's any legal aspect to that property that may cause it not to be let out. Things like EPC reports. And an accountant. Now, the one mistake which is often made is when looking or engaging with a landlord and the landlord asks a tax question, so often mortgage advisors will say, you need to go and speak to an accountant when it comes to tax advice. Well, I would say no. 93% of all accountants are not qualified to give tax advice, no different than you. If you're not qualified to give a tax advice, most likely your accountant isn't. They are historians. Their legal obligation is just to do the accounts based on the structure of ownership that's in place, not to give tax advice. There is only a very small group of accountants who've taken that qualification. And I think it's a really good point for me just to try and get across. Next, you've got a letting agent. With the Renters' Rights Bill now in place in the UK, it's about understanding the legal requirements and the appropriate process for actually putting in place an assured periodic tenancy, what documents need to be issued at what time to make sure that the tenancy is set up correctly. And if in the unfortunate situation the property has to have an eviction process, then it will run smoothly because all the documentation was given out correctly in the beginning. And lastly, and I think most importantly, specifically if that landlord is about to purchase their first ever property, they must speak to a tax advisor. I cannot tell you the importance of not receiving tax advice, specifically because it'll make the difference between purchasing a property and ultimately it not making money and it have to be subsidized from the landlord's own expenses, or buying a property and making a profit. And it is as simple as that. I know friends of mine who've not wanted to take tax advice, didn't listen to me, went for the cheapest rate. They were high rate taxpayers, they bought a buy-to-let, and within that first tax return, not only didn't they make money, they had to contribute in their tax return a few £1,000s to HMRC on a property that would never make money. So let me give you a really good example of something to think about. And this is a real case of a mortgage broker that told me the consequences of bad advice from the first mortgage advisor that this client had ever experienced. So the scenario is the following. Imagine a client comes to you today wanting to get on the property ladder. They want to purchase their first buy-to-let, but it's not for them to live in. It's not their home and never will be. They need a buy-to-let lender that will allow them to be a first-time buyer and also a first-time landlord. So what the mortgage advisor did, and this was an example that happened last year, the mortgage advisor went on to the criteria system and put in what lenders would lend to a first-time buyer, first-time landlord. They came with a list of lenders that would do first-time buyer, first-time landlord, and they were listed against order of the cheapest rate. And I can see that as a logical and understandable way. Turned out that the cheapest rate at the time last year was with NatWest. There was plenty of other lenders that were available, but the mortgage advisor who went with the advice of a mindset of residential went with the cheapest rate because they were doing, in their opinion, right for the client. The client was earning £62,000 a year. This second floor flat was 250,000 and the deposit was £100,000. So they were buying a property for 250, needing a mortgage for 150,000, and their income was 62 grand. So less than 3 times an income multiple. And the reason I say that is a rule of thumb. If the landlord's income is 3 times of the loan amount needed, then you can rule out backdoor residential as a general concern because they could easily afford that property as a residential on that income multiple, and they would also get a better rate if they're doing it on a residential basis than they would a buy-to-let for obvious reasons. So in that scenario, they completed last year. However, it was this year that the consequences of that mindset became apparent with negative effects because the client came back to a mortgage advisor that I know wanting to purchase this house, new build, for £600,000 in Reading. And it was the unexpected impact of the mindset of giving them the cheapest rate, not the correct advice. Because what had happened is when that flat completed last year, they didn't pay any stamp duty because that £250,000 purchase of a second home, or not a second home, their first ever property, and it was in England, it didn't have any stamp duty. Now, I can't imagine as a landlord any good scenario when I was buying a property where I didn't pay stamp duty, and specifically paying the full secondary stamp duty, which was not a good thing. So now, when the client's buying the first ever residential home, they were buying this property and they were going to have to pay an extra £30,000 of stamp duty. That means they were having to pay an extra 5% on top of the standard buy-to-let stamp duty or residential stamp duty. Now, the clients themselves had lost the first-time buyer allowance, which they never got on that first property. And because they weren't selling that first buy-to-let, which they never wanted to, they therefore had to pay second home stamp duty on that purchase. The only thing that the advisor arranging the family home could suggest that they do was to actually sell that flat within 36 months of the completion of the residential. But for two reasons, they didn't want to do that. They wanted that buy-to-let as a form of pension fund. And secondly, they were on a 5-year fixed, so early repayment charges to pay. This was not a good outcome, and this was the negative impact. The clients went and received tax advice there and then. And the only thing the tax advisor could have said was, if you'd have come to me in the first place, I would have advised you must purchase your first ever property, as it's not going to be residential, in a limited company, because you are 26 years of age. And it's logical to expect that at some point in, say, the next 70 years of your life, you'll want to buy a residential home. By buying in a limited company, there is a ruling and a procedure which came in 2013 that protects, because that property is purchased in a limited company, it's not an arm's length transaction, it protects your first time buyer status under the HMRC's rules, and therefore allows them to be able to purchase their first ever residential home, get the first time buyer allowance and pay the basic rate of stamp duty. So just be very careful. In a scenario like this, the clients decided to pursue through the ombudsman the tax advice the original advisor gave, and the original advisor said, I never gave tax advice, but they did indirectly by arranging the property with a residential mindset and going for the cheapest rate, and not explaining the consequences of purchasing that first property in their own name, and the consequences when they come to buy their first ever residential property. So hopefully that really explains that key part of the message of why good advice from a specific specialist. So when it comes to advising on whether or not you buy in personal names or a limited company, you may be able to give a factual explanation of the differences, but you can never give that advice if you do not give, for example, a first-time buyer, first-time landlord, two examples, one in personal, one in limited, and explain the limited company monthly payment may be a little bit higher, potentially, but that is 100% offsettable expense. The slightly lower one in personal names, for example, and it's not always the case, but let's just say it is, you're only able to offset 20%. That's a big difference in the profit and loss and net income position after tax. But more importantly, how it will affect the stamp duty when you, the client, want to buy your first residential home. So that comes to the end of this first part of the absolute basics to buy-to-let. Natalie, back to you.
Thanks very much, Roger. So as Roger's just said, we've now reached the end of part one. So join us very shortly for part two of the absolute basics buy-to-let.